You invest in real estate. Build your wealth by owning professionally managed apartment buildings in the northern New Jersey market. We want to show you how owning real estate is attainable, even for the busy professionals that don't have the time or experience investing in real estate. Now, we only work with select people who are serious about building wealth. So find out if you qualify at peoplescapitalgroup.com. Welcome to the Passive Cash Flow Podcast, where we help people invest in real estate. So on this weekly show, we discuss topics explaining how we help people invest in high-demand real estate and why over the last decade, dozens of people have decided to invest passively with People's Capital Group. Some episodes include interesting guests that span dozens of different types of industries. Other episodes offer analysis of popular topics that pertain to people seeking to learn how to build passive wealth in real estate. So listen in and enjoy our off-the-cuff podcast made to entertain, educate, and help you learn how to create passive wealth in real estate. Today we have a very interesting topic. I'm going to talk about how to invest $100,000 for passive income. So $100,000 is a good amount of money. It's a large amount of capital. Maybe it was inherited or worked for as an IRA or solo 401k. Most of our investors are investing around $50,000 to $100,000 in our real estate syndicate. So it's a pretty popular amount here. So we'll break into how to invest $100,000 into for passive income here. So the goal is to, of course, create passive income. And the bottom line is you have two types of income in this world. You have active income, which you work for. We all have our day jobs and we work for that money. Boy, do we ever. And then we have passive income. That's where our money works for us. Now, the second type of income, passive income, is better. Everyone would rather put their feet up in a lawn chair and just watch those checks roll in, but life's not always that simple. But at this point, we're talking about a $100,000 investment. So how do we create passive income with that $100,000? So first and foremost, as far as investing $100,000, the best way to invest in real estate, in my opinion, is a real estate syndication. So of course, here at People's Capital Group, we operate a real estate syndication. And what that means is we pool capital together to, in this case, buy mismanaged apartment buildings, improve them with our in-house management company so they produce cash flow, they grow in value, and produce a nice cash out refinance for our investors where they can harvest that equity growth every few years and enjoy the benefits of owning real estate, such as cash flow, refinance cash outs, and also tax depreciation without doing the work day to day. See, a real estate syndicate is where investors, passive investors, are bringing capital to the table and investing in a larger property, but only coming in with a partial amount of the investment needed. So it allows smaller investors to get into larger buildings, and bigger is always better in real estate. It also allows people who are not experienced in real estate to team up with experienced professionals, because real estate is a very management-intensive asset class. And if you're not working with the right professionals, even if you're looking to buy a building and hire a management company, that can still be somewhat of a management-intensive asset, and you're still on the hook for the mortgage and the answering the calls of the management company. So a completely passive investment, 100% passive, is not buying a building and hiring a management company. I know, I've done that. There's still responsibilities for the landlord. 100% passive investment is actually investing in a real estate syndicate, is one example where you can then be completely passive, hands off. Of course, do your due diligence on the property, which the operators are going to procure for you. But at the bottom line is just to read those monthly updates, enjoy the quarterly financials along with cash flow checks, and enjoy lump sums upon the cash out refinance is what we offer here at People's Capital Group. Another option is real estate crowdfunding. So real estate crowdfunding is similar to real estate syndicate and a real estate syndication, but the difference is a real estate crowdfunding is essentially a smaller investment amount is required generally. They're online sites that have third-party companies that facilitate the crowdfunding. And the cool thing about real estate crowdfunding these days is you can get started with like $500. So in this case, you might not be working directly with the operators or directly with the syndicators. You're kind of working through a third-party website, but it is a way to get invested in real estate opportunities, completely passive, not be an active investor. And if you have $100,000, a real estate syndication or a crowdfunding site is a great way to put that capital to work in real estate. Now, keep in mind, a real estate syndicate is going to be more of a higher minimum investment, but $100,000 would definitely more than reach that minimum investment amount. A third way to create a passive income with a $100,000 investment is a traditional real estate, house hacking, right? Owning a home, renovating it, and then selling it, moving up to a bigger home, or owning a multifamily home, renting out one of the units while you renovate it, and then selling the property or moving out of the unit and holding on to the property for cash flow. So by house hacking, so you're living in a property, and of course you're using it to live there with your family. And if your spouse doesn't mind a little bit of renovations going on around the house, then you can spruce up the place while you're living there. And depending on the level of renovation, you can flip the property for a nice profit. Now keep in mind, if it's your primary residence, you get to avoid capital gains tax on up to $250,000 individually, or $500,000 with a married couple. So house hacking, where you live in a property, fix it up and sell it, or live in a multifamily property, fix up the unit you're in and fix up the other unit and rent it out, and maybe move out and rent out both units or all units in the unit in the property. That's called house hacking. Okay, that can be done with townhouses or single family homes or multifamily units, 4 units or less. This is a great way to not only live in a home and not pay much rent, say if you have a multifamily property, but also with a single family home, sure, there'll be costs in living there, but as you fix it up and sell it for a profit, of course, you can avoid capital gains tax being it's your primary residence. So traditional real estate house hacking is a great way to more affordably live in a house and create more value out of that and create a profit and flip or buy and hold into wealth over time. Now, that is an active investment. So it's not really a great passive form here. You're actually managing contractors or managing the property as you have tenants. So it's one option for slightly passive in the sense that you're managing contractors, but you're still managing management companies or dealing with tenants or dealing with contractors. So house hacking could be viewed as a passive form of income, but it's really, at the end of the day, it's more on the active side of real estate investing, but it was worth mentioning for sure. Real estate investment trusts, REITs, are another great way to invest $100,000 for passive income. See, a real estate investment trust is a stock backed by real estate. And this is good because you can invest over many markets and many different types of buildings. And the investment's more liquid, meaning you can invest quickly and take the money out quickly as well. The negative to a REIT is that it's more volatile than a real estate syndicate because it's a stock backed by real estate. So you are still investing in the stock market. You are still at the mercy of the stock market, the casino known as the stock market. And really what we find is that REITs are, stocks backed by real estate are so volatile that they don't really offer the benefits that real estate offers, which is a more tried and true, less volatile asset class. So REITs can be a great way to diversify into real estate if you don't want to move out of the stock market. But if you truly want to be diversified out of the stock market with this $100,000 investment, a REIT would not be a great way to do that. If you prefer to be invested in the stock market but also own some real estate, a REIT, a real estate investment trust, could be a good way to go. There's also privately traded REITs that might offer more benefits as well. That's really similar to real estate syndications in a sense as well. So I'm more talking about publicly traded REITs, which are stocks backed by real estate. The main difference between a REIT and a real estate syndicate is that REITs do not offer tax depreciation, where a real estate syndication or even a crowdfunding platform can sometimes offer real estate tax depreciation. Syndicates almost always offer real estate tax depreciation because you're actually owning part of that building. See, when we buy an apartment building with our passive investors, we'll bring in anywhere from 5 to 25 investors, and they're all going to own a piece of that building. So they're going to get their piece of the cash flow, their piece of the cash out refinance every few years, and their piece of the tax depreciation upon each end of each year. They'll get a K-1 tax form showing their profit or loss. Generally, the first few years of owning a building and with tax depreciation, you can actually show a loss but still make an income. So real estate's really interesting like that. If you want to learn more about the tax benefits of real estate, check out some other episodes I've made on tax benefits of real estate. I've made a lot of them out there. But one of the main benefits of a syndicate over a REIT is the tax benefits of a syndicate are better because they offer tax depreciation, where stock does not offer tax depreciation. So if you harvest the asset, sell it, and then produce a profit, you have to pay taxes on that, where with a real estate, you can do a 1031 tax deference and defer all taxes through that tax exchange, which is a whole nother topic. And you can check out other podcasts about the 1031 tax deference. Okay, other ways to invest $100,000 for passive income outside of real estate. So you can invest in stocks. That's one way to invest $100,000 for passive income. Of course, the stock market is very volatile. You always want to have some capital in the stock market. It's a great asset class to build wealth, but you, in my opinion, don't want to have 100% of your capital invested in the stock market. So if you're already very heavily invested in stocks, this $100,000 investment may not be the best place to put it. It's the stock market. It may be better to put it somewhere outside of the stock market. Another option outside the stock market here is peer-to-peer lending. You can lend to people you know, or other business owners, or different people who are doing maybe real estate investments that you trust and know, and you can become the bank. Or you can give a small business a loan, or you can give other peers you know a loan, and they can pay back an interest rate. Now, remember, when you're the bank, you are required to collect that money. And, although it can be a passive check coming in, if your borrower runs into hardships and can't pay, that passive investment can become active, as you may need to hire an attorney, follow suit, or foreclose, depending on what the situation is and how your funds are secured. But lending your money peer-to-peer or on real estate as a bank could be a bit more of an active option, but could also amount to higher returns or earning a nice solid interest rate. Remember, you can't charge too high an interest rate because that could be predatory lending, so you do have to know what you're doing there. ETFs and mutual funds. So a great way to diversify throughout the stock market is by using ETFs and mutual funds. This way you can own many stocks over many different industry classes, and that's a good way to diversify throughout the stock market. I'm not a stock expert, so I'm not going to break into this too much, but that is a popular place, and that's where an individual like myself, who's not a stock expert, prefers to be invested. I'm a real estate expert. Of course, when I go to stocks, I hire professionals to invest in stocks because I'm not a professional there. And I always believe in hiring professionals whenever you go to make an investment. So same with real estate. I'm a real estate professional. People invest in me, in People's Capital Group, so we make the right decisions with their investment capital, with the buildings we're buying and renovating. And that's important to invest with a professional, whether you're investing in stocks or real estate in general. Here's another option to invest $100,000 for passive income. Annuities, right? If you're more around the retirement age, annuities can be great. That means you essentially cannot earn less than a certain minimum interest on your investment, a certain minimum return on your investment. It is a certain form of insurance policy as well. And annuities will allow you to have a floor of what you can earn, generally around like 3 to 5%. So you can't earn less than that. The principal cannot be lost either. So it's a great way to really secure your capital long term. But real estate's going to produce generally a better return than annuities, depending on how the market's going and the type of annuity you have. It could be a more risk-adverse investment, so a safer investment, but of course it might produce a lesser return than something like real estate or a mutual fund or ETF. And of course, another way to invest $100,000 for passive income is to invest through a robo-advisor. That's a way to hire a platform or a program that uses an algorithm to invest properly. Robo-advisors can cost money, so you want to be aware of that, and also make sure your investment goals align with that robo-advisor. But there's lots of ways to invest in the stock market these days for pretty low costs. Here's another way to invest $100,000 for passive income: a high-yield savings account, right? And cryptocurrencies. So a high-yield savings account can produce decent returns, but they're not really going to keep up with inflation. Generally, they're going to be around maybe 1% to 2% at most. Cryptocurrencies, you have stable coins. Stable coins can produce up to 9% income, but of course you want to make sure that you're investing in the right platform, the right stable coin, and you understand what that cryptocurrency does. I myself owned some cryptocurrency. I made a little money, then I lost a lot of money. So, well, not a lot, but I lost most of what I had put in. So at the end of the day, I dipped my toe in the water with crypto. I got soaked like many other investors. Of course, I never sold. I'm holding on for life at this point. But be careful, cryptocurrency is very volatile. It's a new space. Not a whole lot of us know exactly what we're doing there. We're trying to play around with it, but most of us are not really sure what's going on. And many of us are holding the bag, me, myself included. My cryptocurrencies did great. And of course, everything shot down recently. So very volatile space to invest. If this is $100,000 that you cannot lose, I would not suggest putting in cryptocurrency. You probably want to invest throughout real estate and then mutual funds as well to properly secure your investment. Probably half in a real estate syndication, half in mutual funds and ETFs would be a great way to diversify that investment. But here's different ways, of course, that we just discussed to invest $100,000 for passive income. But here's some factors to consider before investing your $100,000. So what kind of investor do you consider yourself to be? Right? Are you a long-term investor looking to invest the capital for a long period of time, maybe over 5 years, 10 years, 15 years, and understand your returns are going to grow over that time as a maturity investment perhaps? Real estate could be a good fit for you. But maybe you're a short-term investor. Maybe you want the money back out in a year for some reason. Then you might want to be more in a stock or a mutual fund where it's more liquid. You could take your money in and out very quickly. Now, keep in mind, a liquid investment can also be very volatile. The more easy it is to access your funds, the more easy it is for everyone to access their funds, right? So that means everyone can pull out as well. So if you want $100,000 to always be worth $100,000, investing in the stock market might not be a good option. If you want to pull it out in a year, well, what happens if the markets drop down a year and the markets are low at that time? Maybe you're going to pull out and lose money. So, we want to consider when you're investing for a short-term mentality that might not be a great mentality no matter what. You might want to have a long-term mentality when investing, especially if you're investing for passive income. Most passive options are going to require a longer-term investment. I know most real estate syndicates, such as ourselves here at People's Capital Group, we require about a 3 to 5 year minimum investment time. So you want to really be on the larger, higher end of that, even with a very long-term investment strategy, maybe a 20-year understanding of what you're going to do with that capital and what your goals are for that capital over a 5, 10, 15, 20-year period is the right way to look at investing, in my opinion, all the time. Also, are you an active or a passive investor? Obviously, we're talking about passive income here. We touched on some things that are a little more active, like house hacking, and then options that are far more passive, such as mutual funds or real estate syndication, or even a crowdfunding site as well. So for passive investments, you want to make sure it's really a passive investment. See, buying a two-family and managing the tenant is not actually a passive investment. It's not actually passive income. It's active income. So house hacking is on this list, but it really shouldn't be, actually, because that's an active form of income. It's not passive. Do you have a certain deadline in mind, right? When you want the funds back, what type of returns do you want to earn? You want to have that in mind whenever you're investing capital. So what type of returns do you want to make on your investment in what period of time? And if you say, well, I want to double my money by tomorrow, then that's not a really good goal either, because what's going to happen is you're going to invest in very high risk options that generally don't produce the rewards that are being promised. If anyone promises a reward that sounds too good to be true, quite frankly, I'd run the other way. Generally, you want to invest in proven operators and a proven asset class, and that's the best way to build wealth over time. Are you going to get rich overnight? No. But any, get quick rich scheme generally doesn't pan out. In fact, generally it loses a capital at the end of the day. Are you willing to take a certain number of risks? So you want to understand your stomach for risk whenever you begin investing, especially in an investment amount of $100,000. If you're investing this for passive income, then you're really hiring professionals, right? Passive real estate investing, or just passive investing in general, means you're hiring professionals. Just like when I invest in the stock market, I prefer to hire professionals. When I didn't hire a professional, I invested in cryptocurrency and I made my own decisions. I lost money because I didn't hire professionals. Now, in that case, I was investing a very small amount and kind of just dipping my toe in the water and fooling around with it. It was nowhere near $100,000, and I knew the money I was investing I could lose. So whenever you're investing money on this level, though, you're probably not thinking, oh, I could lose $100K and not worry about it. You're probably thinking, no, I do not want to lose $1 here. In fact, I want to make returns with this $100,000 investment, and that's what you deserve. Anyone who's put together $100,000 to invest, meaning you already have your savings put in place, your emergency funds, and this is just investment capital, Well, you've done very well now. So you want to understand, what are the risks you want to take on with this capital. Ideally, you want to invest in a risk-adverse type of investment that has lower risk, although moderate returns, as strong returns as possible with as lower risk as possible. So something like a real estate syndication or a mutual fund can be a very good fit for that. What are your financial objectives, right? Over your period of time you want to invest, how much do you want to earn? What type of return on investment do you want to make? Now, I can tell you that most sophisticated and qualified accredited investors want to earn roughly around a 10% annualized cash-on-cash return, right? That means if you're investing $100,000, you should expect to make about a $10,000 annualized return on that investment. You don't really want to be less than that. That's kind of where you want to be as your minimum. Of course, we always try to achieve greater than that, but most financial goals are around 10% a year. If you're achieving that, that's great. If you're doing better than that, phenomenal, right? But your financial objectives, your return on investment should be probably around 10 to 15% annualized cash-on-cash return per year. Investments that offer multiples of that, again, you want to be careful. If they're promising really amazing returns, it might not be the safest investment. You might want to consider other options that are more tried and true. So what are the conditions? What kind of conditions are you considering, right? You want to understand your overall health. What kids do you have coming up that might need to go to college? Do you have children in private school? Do you have family situations that are approaching maybe aging parents or something like that will require excess savings? Always make sure you have that excess savings. In this case, this $100,000 for passive income is being generated as excess income that's available to invest. But of course, you always want to have 6 months of emergency savings available. But take into account your family situation, your personal situation, and that's going to help determine the right investment strategy for you for this $100,000 investment. So that's the bottom line, right? Consider your situation right now. Consider your other investments. There's no silver bullet here. I can't make one investment strategy for everyone. That doesn't exist. What I try to help people with is creating an investment strategy for that particular person. Generally involves a little bit of capital in real estate, a little bit of capital in the stock market, and perhaps an alternative investment beyond that as well. What I encourage most people to do is put about half of their investment into well-managed, professionally managed real estate syndicates. It doesn't have to be People's Capital Group, but if you like investing in the North Jersey market and apartment buildings and feel that's a good tried and true asset strategy, then check out peoplescapitalgroup.com, where you can fill out a qualification form and get qualified to become a passive investor in apartment buildings in North Jersey. Now, that's true passive investing where you enjoy monthly updates, quarterly financials, quarterly cash flow checks, and that allows individuals to benefit from real estate ownership without having to do all the heavy lifting behind the scenes. So that's true passive investment. That's true passive income. So whatever you do, you want to make sure it's not an active investment and you're not running around managing it, which house hacking is the one thing on this list that can fall into that category quite quickly. So look at mutual funds, look at real estate syndications, make sure you diversify your investment over a number of asset classes. Unless you're already heavily diversified in the stock market, then you might want to take this $100,000 passive investment and put it into a tried and true real estate syndication, a real estate syndicate with a good track record with operators that you agree with their overall investment strategy. So if you want to learn more about our investment strategy, you can go to peoplescapitalgroup.com. You can enjoy other podcast episodes about all different types of real estate investment topics, and also past webinars about how we help people invest passively in New Jersey apartment buildings, and that all starts at peoplescapitalgroup.com. I hope you enjoyed our topic today, how to invest $100,000 for passive income. We talked about real estate syndicates. We talked about high yield savings account, cryptocurrency, stable coins, real estate crowdfunding sites, ETFs, mutual funds, general stock investing, and of course house hacking, which really falls more in the category of an active investment, but I wanted to touch on it because some people consider that passive investing as well. So I'm Aaron Fragnilo of People's Capital Group. Thanks for enjoying another episode of the Passive Cash Flow Podcast.